You may have heard that the lease rates for certain precious metals were spiking. I'm Keith Weiner, CEO of Monetary Metals. We do gold leasing. We have a platform. Let me explain what's going on. So first thing is you have to drill into what does lease mean? And unfortunately, there's a lot of different definitions depending on who you ask. And in many cases, people aren't really that clear on what that means. What we do is we get metal from people who own it and we put it into businesses that have metal in the business, such as jewelers. The London market is a little different. The London market is a dollar-operated market, whereas what we do at Monetary Metals has nothing to do with dollars. But the London market is a dollar-operated market, and the main trade is to buy spot and sell forward. And so there's a forward rate, right? If you buy spot at 4,000 and you sell it forward at 4,100, there's $100 of profit in the forward curve. And depending on how much time on that contract, you can put 100 into 4,000, you'll come up with 2.5%. And then depending on how much time is on that contract, you can annualize that as a rate. So, okay, that's the forward rate. And the other trade that the bullion banks would do is borrow dollars, step one, and all of these occur simultaneously. So this is an arbitrage, not a bet of do this and then do that if this happens and then do that. These are all occurring simultaneously. Borrow dollars, buy physical metal, and then sell it forward, and finally lease it out to companies that may want it. And so you get a point of zero arbitrage. So the cost of borrowing dollars used to be LIBOR. They suppressed that signal. So LIBOR is an unsecured rate. That is if one bank goes to another bank and says, spot me, $10 million. Today, everyone likes to quote SOFR, which is literally the secured overnight funding rate when you're posting treasuries as collateral. That's not the same rate, and SOFR is not going to necessarily show the same stresses in the banking system that LIBOR would show. That may perhaps be why they don't want LIBOR being quoted anymore. They sometimes like to suppress signals that might tell people that maybe not everything is hunky-dory. But leaving that aside, there's an interest rate that banks borrow at. There's a cost there. They buy spot gold, okay? They simultaneously sell it forward to pocket the forward rate, and then they lease it out to get some additional, yield on it. And the point at which that yield would be, the net yield of the whole thing would be zero. That's, the lease rate. So the lease rate is LIBOR minus, or was LIBOR, and now it's whatever that rate would be, which isn't quoted publicly, but the banks certainly know. The cost of borrowing dollars minus the forward rate, equals the point that if you lease your metal out at that rate, you neither make nor lose money, and that's their lease rate. Our lease rate is very much different and very much simpler. Our lease rate is how much do we have to offer to pay people who have gold to induce them to put it into, a jewelry store. And completely different market, nothing to do with dollars, nothing to do with the forward rate, nothing to do with interbank lending market. Just has to do with, okay, you've got gold sitting in a safe at home. Monetary Metals says we'll pay you 0.01%. Do you think we're going to get a lot of takers at that rate? Probably not. Okay, 0.02, 0.03. Economics tells us that as the rate goes up, there will be people at the margin who are induced. But if we want a vibrant market, we have to set the rate high enough that, the margin is high enough that we get lots of participants. That is currently 4%. Nothing to do with what's being quoted in London. So what does it mean? We're seeing headlines that the silver lease rate has spiked. And by the way, that I'm looking at the graph right here on my screen, that's largely over. Not entirely, but the market's sort of mostly normal-ish. But back in, early to mid-October, the silver lease rate was massive. So that means a couple of things. One is, there's no such thing as a shortage or a scarcity of the monetary metals, gold and silver. That's what makes them money. There's a vast, vast, vast stock of metal. But there can be a shortage or a scarcity of metal to the market. And so when you see a spiking lease rate, yes, there is a shortage of metal to the market. Now, conventional analysis would say, well, India was importing a lot of silver for Diwali, which occurred at that time. With the price of gold being so high, many Indians were preferring silver, which is obviously a lot cheaper than gold. Yeah, that's true. But something broke down in the silver market, and people, even at those prices, weren't necessarily parting with their silver. And so you end up with the perfect storm. So what happens, just think mechanically. Think interest minus forward rate. And if that equation spikes to 20%, which I think it did very briefly, somewhere between 12 and 20%, depending on how you measure it. That means that either LIBOR spiked, which was not the case. We know that the dollar interest rate did not really move on those days, or the forward rate became very negative. So if you have LIBOR, which is pretty much running flat, and then minus a number that suddenly drops negative, minus a big negative is a positive. So it's LIBOR plus a big number, then you end up with a high lease rate. When the forward rate goes negative, that's another way of saying backwardation. And for regular, especially long-time readers of my work, I've talked a lot about backwardation in the past, and backwardation means scarcity or shortage, and there was a big backwardation in silver. To put it in perspective, I think it was October 10 was the peak of this event. On October 10, if you were to have sold metal and bought the December contract to recover your position, that's what happens in backwardation. You can sell metal to give it up to the market and buy a future to get it back. There was a $2.15 profit on that trade. That's an actionable trade. You're selling physical metal on the bid, you're buying the December contract on the offer price, and you made $2.15 for 2 months of duration. That works out to be, a pretty substantial profit, especially on an annualized basis. That was what was going on at that time. And for whatever reasons, people weren't taking that trade. Now, there's something else that's very perverse that was occurring here at the same time. And that is, think about who is the primary supplier of silver to the market. It's the refiners, right? Because there's all kinds of, whether it's recycled electronics, whether it's recycled old jewelry, whether it's stuff coming from the mines, whether it's melt of, junk silver, pre-1965 quarters and dimes and all kinds of different things, silverware, plates, candelabras, whatever, all made of sterling, that goes to the refiner and it comes out as, bullion and goes to the market. Well, the refiners, whenever they buy silver, they have to hedge. They do not want to take raw, because it takes a few days to refine it. They do not want to take, and depending on the backlog, they could have rooms filled up with, I've seen it, Tupperware bins full of old coins and, junk silver, and in some cases, tea sets, all kinds of stuff that look pretty nice, all going into the melt. And they could have massive, backlog of this stuff. They don't want the price exposure. If they bought it when silver is $52, and then, a week later when they refine it and they're ready to sell it, the price drops to $48. They can't take a $4 loss. The refining margins are nowhere near $4. So they hedge it. Okay, normally hedging means you sell it forward, and normally forward is a higher price than spot. And so there's actually a little bit of profit on the hedge, for a refiner. Now, you take this $2.15 backwardation, that meant the cost of the hedge was $2.15 an ounce on $50 is, what does that work out to? 4% or 4.5% roughly. So if the cost of hedging is 4.5% for a refiner who's hoping to make a margin of probably less than 1%, that's a real problem. And so the refiners said, no mas. And so you have this perversity. And whenever I talk about this stuff, this is exquisite. I mean, in a really bad way. You have this exquisite perversity that there's a scarcity of metal to the market, that because of the dollar system going off the rails, most people, whenever they think dollar going off the rails, the only symptom they can really think of, because conventional economics teaches it this way, is consumer prices skyrocketing. Okay, so we have a situation where consumer prices are not skyrocketing, and yet I'm saying the system is going off the rails. And one of the symptoms, one of the modalities of how it goes off the rails is that you have a scarcity of metal that disincentivizes the primary producers of that metal. If that's not an exquisite irony, if that is not a terrible, perverse incentive and a perverse outcome, I don't know what is. As an economist, I can't really think of anything too much worse than that. So anyways, during that time, the peak of it, the refiners were, first of all, there was people reporting you can't buy silver bars and you can't buy all these things, which is true during that. It's not true anymore, but during that moment. And the refiners were refusing to buy silver at that time. The whole market kind of seized up. And that's a sign of the monetary system going off the rails. Markets should not seize up. A scarcity should mean greater profits for the participants that can supply more. And in this case, not so much. So the question is, okay, how do we distill this down? If you see a spiking lease rate, if you see a headline saying the lease rate is spiking, what does it mean? First thing is make sure you're getting data. Monetary Metals, on our website, we have all this data for free. You can see the graphs. Very often, something happens in the market, and then it corrects itself, and long after that, months later, you see headlines blaring and somebody discovered something. It's already stale. It's already far too late. It's not actionable anymore. Make sure you're not trading on yesterday's news. But assuming it's real, it means that there is a shortage of metal to the market. Now, that usually portends higher prices, because higher prices is the cure for, shortage or scarcity. Or it can be something technical that doesn't necessarily portend that, but that's a better bet than not. If you see spiking lease rates, that means backwardation. If you see backwardation, that means scarcity, and that's usually a good time if you want to make a bet on the price. That's usually a good moment to do so. So the next thing to think about is, if, let's say, the lease rate in silver is spiking, does that tell us anything about gold or platinum? Now, I'm not going to talk too much about platinum. I don't really study platinum. I don't regard platinum as a monetary metal. Actually, it's an interesting anecdote to discuss briefly. So we do leases in gold and silver. That's what our platform is all about, the two monetary metals. Gold leases pay the interest or the lease fee in gold. Silver leases pay the interest in silver. And then we had a request from a good customer that wanted to lease the platinum. So we said, okay, let's talk to our customers and see if anybody is willing to do so. We got a lot of hands raised. Yes, we'll do it. It was very oversubscribed. Okay, great. So we did this platinum lease. And then we said to the customers, would you like the interest paid in platinum? Because normally gold leases are paid in gold, silver leases are paid in silver. Would you like a platinum lease paid in platinum? Or would you like the interest paid in gold? Now, the hint I like to give to everybody when asking, what do you think happened? Number one, the participants don't know each other. So it's not like they all got together and colluded in a room, came back with a single answer. They all answered separately, by email. Number one. And number two, it was unanimous. 100% of everybody participating in that lease had the same answer. And that answer is, we want to be paid in gold. So if I were more academically active, this would be a fantastic paper to write up and submit to a peer-reviewed journal that we just proved platinum is not money. So if I have a mobile phone and I want to rent this out, I'm done with it. It's 2 years old. Whatever, I bought it. I didn't get it on contract from T-Mobile or Verizon or whatever. I want to rent this out. I don't want to be paid in the form of more phones. I want to be paid in the form of money. I'm going to rent this out for $10 a month, not for a fraction of a mobile phone per month. And so that's how, and these are people that were perfectly happy to own platinum. They thought the price was going to go up, which is why they owned it. They didn't want to be paid in the form of more platinum. They wanted to be paid in the form of more money, which is gold. So these metals are different from each other. They have different perceptions, different psychologies, different dynamics, different supplies, different demands, different uses. Virtually all the gold ever mined in human history is still in human hands. Gold tends to be recycled because it's super, super, super expensive. Silver is expensive, much more expensive than, say, copper. Copper is $5 a pound. Silver is $50 an ounce. Times 16 is, what is that, $800 a pound. A lot more expensive than copper, obviously. But, it's not necessarily worth it if you have a washing machine that you're done with, and there's a little bit of silver in the contacts for the switches. That washing machine isn't necessarily going to be recycled for the value of the silver. Whereas if that was gold, you betcha it'll be recycled. So different dynamics, different markets, different things going on. As we mentioned earlier, India was importing more silver. Reportedly were importing more silver because Indians, some of them were switching at the margin from gold, which they didn't feel they could afford anymore, to silver. So the markets are different. And in fact, in October, when the silver lease rate spiked, nothing really happened to the gold lease rate. It was okay. So that was something that affected that one market, but not the other. Now, sometimes the price action, I often think, and I write about this sometimes, or used to write about this, that the psychology can get going, and people, if they see something going on in silver, they expect that gold is going to go up too. And so then they put on their trades in gold, just purely, they think gold has to react the same way the silver does. And so you get a bit of a blip. It could get a bit of a blip, but that's nothing really fundamental. That's just people, speculating. But in the case of silver, there was a real, shortage temporarily. Now there were technical reasons, why, and the situation was resolved. Mostly, the lease rate is back close to, what it would have been, not quite, but certainly not a spike anymore. And so the metals are not the same. Absolutely not. Even though I would call silver a monetary metal, there are vast stocks of silver relative to the annual flows, but it's not gold. What I think is most interesting is how, the market has changed for leasing. If you look at the London market, this idea that you're going to borrow at LIBOR, that's not available. Forget retail customers, even a large family office. Let's say they have $5-10 billion under management. They're not borrowing at LIBOR. That's number one. Okay, they can buy metal at spot, absolutely. They can sell, futures, absolutely. They're not really in a position to lease it out. In leasing, you need boots on the ground, running around, talking to the jewelers and the fabricators and the refiners and the mints. If you're a family office, that's not your business. You're not doing it. So the bullion banks, did that business. And if you're a family office, you can go to a bullion bank and say, would you take my deposit of $50 million in gold, $100 million in gold? Sure, the answer is yes at that level. Are you going to pay me some interest on that metal? Or maybe in some cases, and sometimes no. In other cases, the bank will say, we're happy to. And then they pay 20 basis points. 0.2%. So the bullion bank, this isn't really that much of a help. They're not using, it's not like the bullion bank is taking that metal from that family office and putting it out. The way they get metal to put out is by borrowing at LIBOR, buying, putting it out and selling it forward. And so the bank can add that, capital to the balance sheet, increases balance sheet capacity, but it doesn't really help the bank in quite the same way. And so it's just an example of how in the paper system there are gross inefficiencies that we entrepreneurs tend to talk about that as friction. And so you've got a family office who has metal. They'd like to get a return on it. You've got a jeweler, refiner, mint, recycler that needs metal, happy to pay a return on it. And somehow these two parties are a mile apart. And the bullion bank is perfectly happy with that arrangement, because usually the middleman in an old sort of inefficient, I was going to say broken, but let's just say inefficient, high friction market. The old gentleman's club, middleman is perfectly happy with that arrangement because it's supports their business model, and everyone else, not so much. What Monetary Metals is a platform, with transparency. You bring the metal, and then we say, okay, here's a deal. You can lease it to XYZ party, and if you like it, you click, in our client portal, and then you participate, and you get, the lion's share of the interest. It's not a bullion bank saying, yeah, we'll pay you, 0.2%. Yeah, that's the ticket. The interest rate is transparent, it's published, and it's a market, because that's how we get the metal to put on lease to all these, users of gold. And if the rate is too low, it doesn't draw, the ounces. So it's a market. It has to be high enough to draw the ounces, it has to be low enough that the businesses who need the gold want to do it. And, that's what makes any market, right? So we've changed the market in a way that allows people to participate, includes everybody, down to, retail customers, at 10 ounces of gold. If you're interested in earning a yield on gold paid in gold or a yield on silver paid in silver, click on the link below, monetary-metals.com.